Are you tired of tying up thousands of dollars just to run a covered call strategy? Imagine if you could grab the same potential upside without owning 100 shares. In this video, I'll show you a clever option strategy called the poor man's covered call. It's cheaper, it's powerful, and it could change the way that you trade. Let's dive in. So just before we get started, I'll show you some slides and explain what the difference between a covered call and a poor man's covered call is. This is not financial advice. Investing is risky and options are complex. Do your own research before making decisions. I'm not giving you any advice at all. So poor man's covered call. So this is a option payoff chart. So we've got the two dimensions. You've got the profit and loss expiration, profits up, losses down, and then the underlying price expiration running from 0 on the left to infinity on the right. In a long stock position, your profit would increase as your underlying increases in price if you were long. In the covered call and the poor man's covered call model, which have a very similar payoff, if the stock goes down, you lose money. But if the stock goes up to the strike price of the short call, you'll make profit. Once the stock price rises above the strike price of the short call, you will start to lose profits, but not actually any money that you've received. So that's the max profit, the strike price of the short call. So yeah, covered call model, you need to own 100 shares and then sell at least one out the money call. If you own 200 shares, you could sell 2 calls. That would keep you covered. In the poor man's covered call model, and the poor bit comes from the fact that you have a lower margin requirement. In a covered call model, you've got to buy 100 shares. That's expensive. In the poor man's covered call model, you've got to buy one in the money call, which has time decay and therefore means that its value is less than 100 shares of the stock, which means it's cheaper. So you can use less money in your account to get similar leverage to a long stock position. So you'd buy that in the money call. I tend to buy just within the money, maybe like 10-20%. And then you'd sell one out of the money call, and the out of the money call would simulate that covered call model. So the pros of that, you've got lower capital requirements, you've got more leverage in some cases, and you've got similar upside, if not more. Big cons are there is time decay. So if the stock moves away, you can't just sit on it. You've got a long contract which would expire. This is obviously more complex, and there's limited liquidity in these options. And then when do you want to use it? So if you're bullish on a stock but you don't want to commit the full capital, you want a recurring income from selling call premiums, or you believe the stock will move up moderately. So this is why I use it. So I would buy a long call because I don't want to use all my money on stock. I would then sell short dated calls, maybe like 1 or 2 weeks out, slightly out the money, just to collect a premium and generate income month on month. On the screen, I'm showing WealthBee. WealthBee is a trading journal and portfolio analytics tool based on the web. You can upload your trades from a variety of brokers, both manually and automatically, and it gives you insights about your trading and performance. On the screen, I'm showing the dashboard, which has numerous insights that can be enabled. We also have the positions page where you can group and tag your positions into different strategies and allow you to view statistics about those positions over time. At the moment, I'm just showing what's open, but I have all my history in here as well. There's a load more to this as well, but it's the tool that we use to do our analysis, so check it out if you're interested. So I'm going to quickly construct a poor man's covered call and a covered call to explain the differences. So I'm on WealthBee. I'm just going to go and add some manual trades. So first we'll add our long equity. So we'll do this on Apple. And this will be our covered call. Since the covered call has the equity part and a poor man's covered call only has a option component. So let's add that in here. So we're going to buy Apple at 100. We bought 100 shares and we'll just put through that trade. So here we've got our long leg of Apple, one equity. So we're going to add the option side. So in a covered call, you would sell an option. So we'll say on Apple, we will put the strike at 110, so just out of the money. Cool. The trade date will be today. The expiry can be this Friday, and we'll say that that we're selling it, and the price per contract is 1, and we did 1 contract because we only have 100 shares. So this is your covered call. You've got your equity, so you're long on the equity and you're short on the option. And if we open this up, we can have a look at the option payoff. So you can see here, we've sold our option at 110. The price of the stock is 100. Once the stock price starts to go above 110 before expiry, we start to lose out on profits. but we're covered because we own the equity. If we create a poor man's covered call, there are two components to this. The first component is that we go long with an in the money call. So we'll say we buy this at 80. The expiry can be in June, so 20th of June, and we'll say we're buying a call. The reason it's long is that gives you lots of time for the stock to move around in price, and means you don't get caught in short-term movements in the stock. It also simulates the long part of the lag. So if we put in here and put in poor man's covered call, and we're buying it, and because it's what are we, 20 in the money, let's say it costs us 22, 24 probably, and we're buying one contract. Then you repeat the same thing on the other side as you have done for the covered call. You would sell a short call. So if we go to options, add in AAPL, I'm going to sell one again at 110 because the stock price in our example is 100. And we'll do a short dated one. So we'll literally do that for the coming weeks, so 7th of February. So go to call, sell it, put it in the poor man's covered call book, sell it for probably the same as the other one. So $1, one contract. And we put that in there. So we're now in the theoretically the same kind of position, right? But the big difference here is that the cost basis is much, much lower. In this one, our cost basis is $2,300, whereas our cost basis in the covered call is $9,900. So you've reduced your outlay and the amount of cash that you are required to have to do this trade, but your actual leverage is very similar to the covered call model. So something to know about a poor man's covered call versus a covered call is that in a covered call model, if you have to buy 100 shares of a stock, and let's say that stock's at $100, that's going to be $10,000. Whereas with a poor man's covered call, the option that you'd buy, which has a date for expiry, and it will be deep in the money, won't cost you $10,000, it might cost you $2,000 or $3,000. But you get the same leverage, you just have the risk of decay. So if we go through some pros and cons, on the pros side for a poor man's covered call, you have a lower capital requirement, it gives you more leverage, and you get the kind of similar upside to owning the shares depending on how far you go into the money. On the cons, the biggest con is that you have time decay. So if the stock doesn't go the way you like it to go, with a stock you could wait this out. With a call, it's going to expire and you may have to roll it. It's also more complex. It means you're going to have to manage more positions. You're going to have to think about this a little bit more. And in terms of liquidity, deep in the money options may not have the liquidity that you're looking for. So when would you use a poor man's covered call? So you might be bullish on a stock, but you don't want to commit your full capital to buy 100 shares. You may want recurring income from selling call premiums on top of your initial outlay, and you believe that the stock will move up moderately or at least stay stable enough for you to get your short call profit. So I'll show you an example of a few trades that I've done here. This is my Schwab portfolio. I've got a number of poor man's covered calls open at the moment. I'll just filter down to those. So here you can see I've got Nvidia. If we open up Nvidia and have a look at the chart, we'll see that it's fairly bullish. Obviously gone up a lot in recent times. So my thinking here was that this stock's going to keep going up, but we can also see that it's been in a bit of a channel for about 6 months. And so I've bought my long call, and I didn't want to outlay the full amount, so I bought a long call. So you can see that here. I've got one long May 16th 100 strike. So if we put the 100 strike on here, that would be around here. So you can see it's deep in the money. And when I bought that, that would have been probably $30 in the money, so about 30%. And that cost me $3,600 to buy versus probably $14,000 to buy the actual stock. So that's long term and that expires in May, so I'll just drag that out to May. I then sold the call at 150, which is up here, and I did that based on the previous highs. So if I just add that on top here. Now that's a much shorter dated option, so that expires in 10 days time, and it's the 18th of February, so we're looking at about the 28th of February there. So that's going to expire on that date, and if Nvidia goes up, my long call goes up in value. The short call would go up in value, but it expires then. And of course, if it goes above that, I don't actually lose any money, I just lose profits. and I can close that position and then close the long call if I wanted to. But what I would actually do is just buy that back when it gets close to expiry, when it's got a low value. Another option here I did with Oracle. You can see here again in a similar channel. So if I show you where I went in, so I bought my long call, 2 of them actually, at 150. Let's have a look. 150 is, or no, I'm still looking at the wrong chart. Let me open that up. Oracle. So I bought it at 150. So here, deep in the money, the day I bought it, there was a huge drop, and that was my my thesis, was that the drop was an overreaction. So I bought it at 150 for 88 days, expiring May 16th. And then we sold the short side at 180, which is around here, and that expires in 11 days time, so the 28th of February, which is about there. So same theory, this long call will go up in value as the stock goes up. The short call will hopefully expire valueless if Oracle remains below 180. If the stock is below 180 by February 28th and that expires, I get to keep my money, and then I can rinse and repeat this process over and over again, increasing my profits as we go while the stock goes sideways pretty much, or moderately up. On the option payoff chart, this is how it looks. We've got the underlying price here, my short put and my long call. So you can see there's an increase in profits there as we get closer to expiry. So that's the poor man's covered call in a nutshell. If you found this helpful, give us a thumbs up and subscribe to our channel for more trading tips. Head over to WealthBee.io for more tools, guides, and community discussions. Thanks for watching, and happy trading.